But first of all, thank you guys so much for coming today. I think it's great that we, in a fairly small sort of situation here, where we can hopefully get some really good engagement going as well. So the sessions we're going to run today, there's two sessions. The first session is having a look at our speakers. They're going to talk a little bit about their firms, a little about the strategies, the services they provide, and in the light of, I'll get to the right slide, which is behind me, in light of the theme. So we're talking here about global equities, but the themes, as Toby was saying, one of the main themes is obviously the US election. How are we going to invest in global equities? What are these guys going to talk about is that through Australian investors' eyes, but we've added a couple of additional themes in there as well, which I think are really important at this point in time. So you've got geopolitics. We all know that there's a lot of uncertainty in that. I think the election brings even more uncertainty in that on how that's going to play out. You've got the European and UK influence there as their political landscape changes, they have growth issues, etc. And then of course you've got monetary policy, you've got the Fed maybe having a soft landing, maybe having a hard landing, maybe having no landing whatsoever. So we want to have those themes that are there. So that's the first part of the session. So each of the guys are going to do a presentation. They've got some slides, they'll take you through it, give you their sort of viewpoint, what their firm does. Then we'll have a quick short break, and then we'll have a session which is a Q&A session. We would really like that to be iterative if at all possible. So I'd like to get questions from you. We've got a set of prepared questions as well, just in case no one has questions. But it's always better to get questions from the audience as well. So what I might do now is I'm going to hand over to Grant first. The bios of our speakers, the full bios, will be at the back of the presentations. But just as I introduce each of the speakers, I'll give you just a quick sense of that. So Grant, if you want to come up. Grant is a senior economist with Vanguard Investment Strategy Group in APAC, where he's responsible for research on economics, capital markets, and related investment topics. He works closely with the portfolio management team in Vanguard's fixed income group and contributes to Vanguard's global thought leadership through research on markets, economy, and investment strategies. His areas of expertise include monetary policy, which might come in quite handy here, international macroeconomics forecasting, also with a bent on Asian views on that as well. So, leave it up to you. Thank you so much, Grant.
Thank you, Gary. I'm so glad that I can, thank you for having me here. I'm so glad that I can have this opportunity to introduce myself, my company, and some of our research, our in-house views. So I'm Grant. Currently I'm a senior economist covering Asia-Pacific economic research at Vanguard. So for this particular region, APAC, we cover like a wide range of economies in this area, and we also try to analyze what's the spillover to the other parts of the world, and what is the spillover from other parts of the world to Australia and to the broader context in this region. Specifically, we cover China, which is obviously the most important growth economy, growth engine for this region, and we also cover Japan because it's also important, especially for the overseas investment from like the Japanese investors' point of view. And we also cover Australia because Vanguard Australia has a big exposure, large business in this particular region. And so far we also have been the largest ETF provider in Australian market. And in addition to those several big countries, big economies, we also cover emerging Asia because we know that emerging Asia has a stronger growth momentum, and hopefully they can generate a higher expected return, investment returns than the DMs, especially in the US for the next decades. So today I will share a little bit more about our economic and market outlook. Yeah, I think especially start from like last year to now, and if we look ahead into next year, probably we want to see what is the global macro theme, right? So I think the key message, the key theme would be like the policy pivots across the whole world. Because now we see the global inflation started to recede from the peaks, and some of the countries, their inflation will be declining more faster than other countries. Some countries like Australia, the inflation is still very sticky. However, there is a kind of global synchronization across the central banks. Means that the policymakers, the central banks, they started to pivot their due mandates. One is the economic activity, the other one is inflation. So that's why we call it the policy reaction function synchronization, right? So we see that global inflation has started to decline. And I think that phenomenon applies to both the US and generally the global economy. And thanks to this, we see the global central banks are focusing more on the, let's say, full employment side of the due mandate. That means that in most of the DIM markets, the developed markets, the central banks started to cut the interest rate. And we see the interest rate in most of the DIMs starting to come down. So for economic growth, if we just look at globally, we see the US growth is still firm, but it's still moderating. But we don't see that, oh, the US will have a risk of recession. It's still resilient. And inflation in the US, they started to decline. However, it's still kind of above the central bank's, the Fed's target, but it's still declining. However, because of the resilience of the US economy, because of the tailwinds of the US economy, we see the last mile of inflation fight will take more time, it will take longer. So in Europe, we see their economy has been recovering. However, there is a higher risk of like the continued moderating growth. And maybe because the European economic growth has been less resilient than the US, so we see that they make more progress in terms of the inflation fight. And we expect that ECB, the European Central Bank, will continue to cut the interest rate down the road. In Asia, for example, Japan, we see, oh, it's opposite picture. Because we see Japan is gaining momentum in terms of both economic growth and inflation. So that's why we expect the Bank of Japan will continue to hike the interest rate. Although we believe their pace of hike will be very gradual, given their very cautious point of view, given they don't have much conviction about the overheating demand side of the economy. And for China, which used to be the single largest growth engine for the global economy. However, we see the Chinese economy has been suffering their own problems, like the structural headwinds and short-term cyclical momentum loss, including like both the property crisis, both the headwinds from the demographic challenges, including the less resilient, less than expected the policy momentum, policy stimulus. So we will touch on these topics in more details later. So if we look at the US, a lot of people are discussing whether it's a soft landing or hard landing or there's no landing, we're still in the middle of the cycle. However, our base case view is because we see the tailwinds, especially from the sell side, started to normalize, started to moderate. So that's why we expect the US growth will start to accelerate. Although we don't think that there is a risk of recession, the US economic growth will started to decline towards the trend growth rate. So that's why we call it a turbulent landing. That means that we expect the low trend growth towards next year. This year will be just a decline towards the trend. Next year, there will be slightly below the trend growth. And we see there are four powerful growth forces are starting to moderate, are fading out. First one comes from the consumption side. We see the exact savings accumulated during COVID has almost been depleted. Through this chart, we can see that, okay, from the peak, they have already largely declined. And secondly, we see that the US job market, the labor force market, started to balance, started to moderate. And also we see the driving force from the strong immigration flow into the US labor market is also started to moderate from the peaks. And eventually, and also more importantly, we see the US supply side productivity growth started to moderate as well. And the cyclical productivity boost is likely behind us. They just recover back to the trend growth. There will be less stronger productivity boost down the road. So that's why we see the US inflation, they have largely tamed. However, the labor market, the unemployment in the US started to pick up, although the magnitude is still moderate. So that's why we see with the Fed started to enter the easing cycle, we expect the greater synchronize among the major central banks around the globe. There's only one exception, which is Japan, and we will explain why in more details later on. So for emerging Asia, because we see they have benign growth and benign inflation compared to most of the developed markets. So that's why we see the emerging Asia central banks, they will start to cut, but they will cut lag behind the US moves, and the magnitude of the rate cut will be slower and shallower than the Fed's. China, which obviously a lot of discussion around like starting from end of September, a lot of discussion around like this round of China policy stimulus, what's going on, what's the impact, right? We want to explain why we see the impact of this stimulus will be kind of notable than last year, but it's definitely not whatever it takes. However, we want to explain why China's stimulus started to pick momentum recently. So we see Chinese policymakers, including both the government and the central bank, they are different from most of the Western central banks. Like they only have, most of the Western central banks, they only have dual mandates. But for China, they have a multiple targets framework, right? So now, sure, thank you. Yeah. So now we think PBOC, they started to move the importance of economic growth to a high level, given the deflation risks, given the lingering momentum suffering risk. So that's why we see there will be more intensive policy easing down the road compared to the last rounds of economic cycles. And to measure the impact of the policy stimulus, we see monetary policy, although they cut the interest rate more notably than the past. However, we see the monetary policy shouldn't be the focus because monetary policy has likely reached this limit because of the weak demand, because of the weak business confidence. So that's why we think fiscal policy should do the heavy lift, and the monetary policy should be able to facilitate the fiscal expansion. And we also want to know whether it is a shot in the arm or is a kind of fundamental change. Is it a kind of sustainable turnaround? If we compare China with Japan with the US in the previous economic cycles, for example, if you look at China's housing market, which is the biggest drag now, we see there's still a long way to go for China's housing market to fundamentally clear the mess. Because eventually, no matter how hard the government try to intervene in the housing market and how strong the policy stimulus will be, however, eventually the supply and demand have to reach an equilibrium. They have to clear eventually. So that's why if we draw the experience from Japan, from the US, we see there's still a long way to go. And we also see that in terms of like the business confidence, the demand confidence, especially if we look at the money M2, which is representative of the money in circulation, we see it takes more time to fundamentally revive the animal spirits and fundamentally reflate the economy. So I probably quickly jump to Japan, given the time constraint. We see Japan, they have already been muted in terms of economic growth, in terms of inflation in the past 3 decades. And now, finally, they exit from those kind of deflation cycle, and they finally started to normalize the monetary policy. And also, because of this, because of the economic pickup, Japan finally come back to global investors' vision now, right? So we see there is a virtuous cycle between wage and inflation in Japan, and we see there has been a formalizing a positive feedback loop between price and wage growth. So that's why we believe there will be a sustainable inflation down the road in Japanese economy. And due to this, we expect BOJ will continue to normalize their policy down the road. However, in addition to inflation, they also have to consider about like their exchange rate. They also need to consider their capital market stability. So that's why we expect down the road, if the yen will gain some momentum, they won't depreciate quite a lot. If the capital market will likely stay stable, Bank of Japan will continue to normalize their monetary policy. Otherwise, if there is some external shocks, we believe Bank of Japan will be more cautious than Japan. So I think that's all my view. Thank you very much.
Thank you so much. Thank you, Brad.